To be forewarned is to be forearmed. As an investor, it's very important you have the knowledge of the early signs of a typical market bubble. How do you spot? How do you identify the signs, the early signs of a market bubble? That is the essence of this video, spotting the early signs of a market bubble. Number one, you need to take into consideration is there's this rapidly rising asset prices, rapidly rising asset prices. A key indicator of a market bubble is when asset prices increase at an unsustainable rate. And if stocks, real estate, or other assets experience a sharp rise without corresponding improvement in the underlying fundamentals like earnings, or economic growth, it could signal the formation of a bubble. Asset prices just rising without a supporting fundamentals. It's an indicative of the fact that the market is about to experience a bubble. Number two is overvaluation. Overvaluation. When common valuation metrics, such as price to earning ratios, price to book ratios, or dividend yield, if they significantly rise above historical, averages or industry norms, it may indicate that assets are overvalued. When these metrics, are rising above historical average, it shows that the asset involved is experiencing overvaluation. Overvaluation suggests that prices are driven more by speculation rather than by the intrinsic value of the underlying assets. Number three is excessive speculation and FOMO. Excessive speculation and FOMO. FOMO here means fear of missing out. And in a bubble, speculative trading and a fear of missing out, this kind of behavior tends to dominate the markets. You discover that investors chase after rising stocks, often ignoring, the risk in favor of short-term gain. The widespread belief that price will only go up, is a red flag for potential bubble. When people believe that, when investors believe that, price will, rise virtually to the sky, it shows that, it indicates a market bubble. Number four is media hype and public euphoria. Media hype and public euphoria. A market bubble is often accompanied by intense media coverage and public enthusiasm. People are very enthusiastic about, buying stocks, pouring into stocks. So when mainstream media outlets, celebrities, or everyday investors start, touting an asset as a short thing, it can indicate that speculative mania, is taking hold, pushing prices above rational level. The news media would carry news about the markets. Individual investors will pour in, like a frenzy. It indicates that the market is actually, displaying early signs of a bubble. Number five is rising leverage and margin debts. Rising leverage and margin debts. There will be an increase in borrowing for finance investments. People borrow to finance their investments. And not only that, this could be accomplished through margin debt. It signals that investors are becoming more willing to take on risk. People borrow to invest. People, trade on margin. They use uh, an uncomfortable level of leverage. So excessive leverage amplifies both potential gains as well as some potential losses. And when used extensively, it can contribute to a rapid inflation of asset prices, making a bubble, more vulnerable to a sharp collapse. That is it. People borrow and they trade on margin. They take on huge debts, which will eventually uh, come up to hurt them later on. Number six is a widespread participation of inexperienced investor. When inexperienced investors keep on pouring into the market as a result of democratized investing through apps, without skills, without proper knowledge or training, that's a red flag that cannot be ignored. When inexperienced or retail investors flood the market, it can be a sign of a bubble. The bubble is forming, or a bubble is about to form. You know, Newcomers often jump in during the last stage of the bubble, drawn by the fear of missing out. They are compelled by FOMO. They've heard news about their friends who made a killing in the market, and they want to come in to partake in the gains. And they do that without fully understanding the risk involved. They just buy and buy without considering fundamentals. Please subscribe to this channel if you've not done that, and like this video. You may equally drop a comment in the comment section. I think it will go a long way in helping me in this channel. Number seven is disconnection from fundamentals. They completely ignore fundamentals. They disregard intrinsic value, and that's a very important red flag. So during a bubble, there is often a large disconnect between asset prices and the economic fundamentals, and even the fundamentals of the company or the assets involved. For example, stock prices may rise without corresponding improvement in corporate profits and earnings. And real estate prices may equally climb despite stagnant wage growth. When real estate prices start growing, start climbing without any supportive growth in wages, then that is a red flag. When prices decouple from fundamentals, it is a sign that speculation, not real value, is driving the market. As I told us earlier in one of my videos, I made mention of the fact that unfortunately, market most at times is driven by investor behavior, by greed, by fear, by psychological, emotional factors other than the company fundamentals. Number 8 is fear of missing out and herd mentality. Fear of missing out. People are driven by FOMO. It drives them into irrational behavior. Encouraging individuals to invest in an asset simply because others, maybe families and friends, are doing the same, are doing so. You just want to join the band and bandwagon, so they will not miss out of the potential gains in the market. This herd mentality can inflate prices and create an environment where decisions are made based on emotions rather than by rational analysis. People don't really sit down, think critically, and analyze the assets involved. They simply buy based on emotions, based on fear of missing out, and even based on greed. And number 9 is rapid growth in unproven sectors or assets. Rapid growth in unproven sectors or assets. People just buy shares They own companies that are just emerging companies with no proven, track records, of past stellar performance. They just simply buy. So bubbles often form in new unproven sectors, as during the dot-com bubble, where tech stocks, or the housing bubble, like in the case of the mid 2000s, people just, at that time, whenever a company bearing the name .com, people just buy. Investors simply pile in. We saw what happened during the housing bubble, the global financial crisis. People just, took out mortgage loan without the capacity to pay. And so when they couldn't pay en masse, then it resulted in the housing bubble. When investors flock to speculative assets without a clear understanding of their long-term viability or intrinsic values, it often signals the early stage of a bubble. Number 10 is widespread optimism and unrealistic expectations. People are just optimistic, optimism that has no anchor on reality, that has no basis on reality. When investors begin to believe that the asset price will continue to rise indefinitely, or that it is different this time around, this time is different, those three words are very, very, they are dangerous when it comes to investing. This time is different. How is it different? History repeats itself. It may not repeat, but it rhymes. It will tell you this time around is different. You just go ahead and buy. It suggests that irrational exuberance is at play. Unrealistic expectations of future gains or growth can drive price beyond reasonable limits, leading to the formation of a bubble. So in conclusion, identifying early stage of a market bubble requires careful monitoring of market behavior, asset valuations, and as well as some investor sentiments. And you also consider media narratives. By recognizing these indicators early, investors can take proactive measures to protect, their portfolio and avoid the risks associated with a bubble-driven market.